Awesome. Well, good morning to you both. Thanks again for spending a little bit of time with us this morning. I shot Patrick an email that has the enrollment materials, the documents that we're going to be reviewing today. The most important one is going to be this online enrollment packet, which is the first document. It's 14 pages. And we'll start with that, but I wanted to briefly introduce myself. I'm Ian Campbell. I'm one of the financial advisors. My business partner, Mark L., is also another one of the financial advisors that's on your 401k plan. We're available to each one of you to reach out to. If you've got any questions, need help with this, or need help with anything in the future. We don't go away either, so this is not a one and done. As there's other employees that become eligible, we'll be doing these types of enrollment meetings for those individuals as well too. We are constantly reviewing these investments, the 401k plan quarterly as part of our service model, but you can reach out to us at any single day if you wished. So I wanted to start with that. We're going to switch over to the documents on the screen. The first one being the online enrollment packet. It really starts on the second page. We like to start with this because this is the most important thing. If you forget anything today, this is what I want you to remember. The second page of the online enrollment packet. The first step for you as an individual to enroll in the 401k plan is to go to the provider's website, which is yourplanaccess.net/retirement plan consultants. Retirement plan consultants is the provider, so they are what's called the record keeper, and that's where your account login will go through, and that's where the money's essentially held. Like, other companies you might be familiar with would be like Charles Schwab or Fidelity. Retirement plan consultants is that company. For the initial enrollment, once you get to that website, there'll be a gray box in the top left corner. You'll hit online enrollment for that first time, and it'll prompt you to type in a plan password. And the plan password is going to be Redwood and then a capital T, all capital letters as well. So make sure you are putting that information in as you go through those prompts. I'm going to hop down to page 8 of 14. And kind of what I was visually explaining is what you're seeing on your screen now is the website, and that gray box that I was referencing. That top left corner is what you'll click, type in that plan password on the next step, and then you'll be prompted to putting in your contact information, date of birth, social security number, and setting up a username and password to verify your identity. After you've done that, you'll get through some steps of putting in your contact information, inputting beneficiary information, and then also making those decisions around how much you want to save, pre-tax or Roth, and then also the investments. I wanted to point out just one piece before we hop over to a different form and start talking about the decisions that you'll be making. About halfway through the online enrollment piece, there's a section where it asks, what source of money do you want these investments to be allocated to? Or how do you want your money or buckets of money to be invested? If you click all sources of money, which is that purple box, which is what we recommend, all that means is that if you've got company match money or that company contribution plus your contribution, they're going to be invested the same way, or one investment philosophy. If you wanted to do multiple investment philosophies for, call it the different types of money or buckets of money, then you would have to have investment selections for each one of those money types. But honestly, it's our recommendation that you just keep one investment philosophy for your bucket of money or your retirement account in there. So we're going to hop over to, I'm going to actually go back up on this screen because we'll reference it back here in a little bit, but I'm going to hop over to the actual paper version of the enrollment form. We don't recommend folks use this. If there is something that you absolutely have to use the paper form for, you can, but we prefer from a security standpoint and ease of use and really just safer for everybody and faster for everybody is to do the online enrollment. But for the discussion and the call, we like to reference this form to give you an idea of what types of information you're going to actually be putting in the system, but also the decisions that you'll be making as well. So the top piece is all self-explanatory, your contact information. What is unique to each of you is going to be your date of hire. So if you don't know it offhand, double check with Patrick. Make sure you've got the correct date in there. It's important based off of eligibility that you have that right in the system or it'll get flagged. Below here is going to be the start of our discussion around enrollment. For those who do want to participate in the plan, you've got those two options, pre-tax and Roth. But the reason why I bring up this paper form, this will be used as a waiver for those who do not want to participate in the plan. So if you have an employee or you yourself don't want to save or start, participating in the plan, you'll actually complete this form or this paper form, fill out the top section, and then you'll select this third option where it says, I elect not to contribute in the retirement plan at this time. And then you'll sign the second page and turn it back into Patrick. Patrick, you'll just keep those for your records. We don't need a copy of them. All it really does is it gives the employee a form that says, here's your benefit, and then you have a record of them saying, I don't want to participate at this time. The form does not need to get updated every month or every quarter. It's good for, the no going to in the future. If an employee wants to start saving after they've said no, the enrollment windows are monthly. So if you say no now, you can start, call it August 1st or September, October, November, whenever. You just have to wait to the following month. You could say no for a year, 6 months, and then start that following month. So it's not a no forever. So does that make sense to everybody?
Yes.
Okay, awesome. So for those who do want to participate in the plan, you've got those two options that I referenced earlier. You've got two different types of money or contributions you can make. You got a pre-tax contribution or a Roth after-tax contribution. And the difference between the two is when the money is taxed, it's either taxed on the inbound and you're paying taxes today, or it's taxed on the outbound when you pull the money out in retirement. And depending on what your tax bracket is today and what you foresee tax rates to be when you retire and 20, 30, 40 years from now, you could kind of argue and hedge, I'm going to rather pay my taxes now because they're low, or I'm going to pay them in the future because they're going to be lower then. We do not know what tax rates are going to be in 10, 20, 30 years from now, so it is somewhat of a best guess. From a general standpoint, we tend to see most people will actually do a pre-tax contribution. With that being said, because they're going to go and take the tax benefit today because it'll reduce their taxable income, for tax time. That's the common thing, and then your paycheck doesn't drop down by as much as what you put in. So you could save, let's just say $50 in your 401k account. Your paycheck's probably only going to go down by about $30. So you have a little bit of a net benefit from the tax savings there. So that's the pre-tax scenario. You're going to pay taxes as you pull money out in retirement, though, at whatever your effective tax rate is in retirement. The opposite happens with Roth, is you're going to pay taxes today on whatever your tax bracket is or your income is. And then when you retire, you've already paid taxes. So that's all your money, 100% of it. You're not going to be subject to any taxes after your retirement age. The argument for Roth is that, tax rates have to go up sometime. They're really historically low right now. You'd rather, pay the taxes now than an unknown rate in the future. The best recommendation is to do both. And what that affords you is options in retirement. So depending on your income in retirement, your circumstances, you have options to pull from either a bucket that you have to pay taxes on or a bucket that you don't have to pay taxes on. And just having those options would be a recommended path. It's common to see folks in their 60s years, a year old right now, because Roth wasn't around when they were just starting to save, is that they have a lot of pre-tax savings, and they have to pay taxes on that. They don't have any after-tax savings saved up. So a recommended path would be to do both. What I'll talk about is the company match and how that works here in a second too, but I just wanted to see if there's any questions on pre-tax or Roth. If that makes sense to everybody.
Yeah, I'm good.
Okay. So hopping over to the next kind of decision that you'll be making is the how much piece. I personally feel it's the most important. If you're doing pre-tax or Roth, you could argue that it's probably going to work out to be the same regardless of whether you're making money, now or making money in retirement. The how much piece is very important on your savings rate, on getting to a comfortable number and replacing your lifestyle in retirement. The reason why the 8 and the 10 numbers are there, 8% is the national average across the country, all age groups, all industries. The average individual is saving 8% of their income into the 401k plan. So use that as kind of a watermark. If you were to ask me, Mark, our office, Google it, any other financial advisor, trade journals, research, the number really is 10% of what you should be saving. And that 10% number is for somebody that's in their 20s, honestly. And what I mean by that is if you're in your 20s, the research has shown is that you need to save 10% of your income for the rest of your working career to replace that lifestyle that you've had in retirement. If you're late to the game, if you're in your 30s or in your 40s and you don't have a decent amount saved up, then that 10% number, really is probably closer to 14 or 15% from catching up for lost time. So we want to be realistic with the number of what you're saving, but also be mindful that, starting up a 401k plan and automatically saving 15% of your income may not be possible for many. And that's why you have full discretion of what you would like to choose at whatever number as well. So with that being said, 8 and 10 would be a good number to be at or get to. Beyond 10 would be great. I mean, you're saving for yourself. You're not saving for us. You're not saving for your boss. I guess you could say, you argue you're saving for your family as well, but you're saving for yourself. And one time in the future, you're going to be 65 or 70 and not have that income coming in, and you're going to need to live off of something. So saving is very important. The most important thing that you can do is save as early on as you possibly can. You can probably ask colleagues, friends, relatives, what they could do. One thing differently with their saving is that they would have saved sooner. So, use that as kind of a shake right now is save. If you're trying to procrastinate a little bit when it's a better time in the future, don't do it. Get going a little bit, and we'll build up to a bigger number. So I'm going to hop over to kind of the company match side of this, which ties into how much you're saving. The company match is what's called a safe harbor match. And in the email that Patrick will pass on to you, it's broken out as well. So you can kind of refer to that. It's a 4% maximum match. And what I mean by that is if you save money, you're eligible to get up to a 4% match. And the equation is 100% on the first 3% that you put in, and then 50% on the next 2%. So if you put in 1, you'll get 1. If you put in 2, you'll get 2. 3 for 3. If you put in 4%, you'll get 3.5%. If you put in 5, you'll get the full 4. It behooves everybody to at least start at 5% or save above 5% to get the full 4. Okay. If you're doing something less than 5, that's where that equation comes in, and that table will work out. Again, if you're going to be in that savings rate, we want to see at least your contribution at that 8% level or greater to be at the national average from a savings rate. And you could say that you're saving 8 plus the company's 4 for a total of 12. Again, that's a good number from a savings standpoint, and just be consistent with that. What's also is important, and I wanted to kind of explain a little bit of detail. If you're saving in a Roth account or a pre-tax account, your contributions, that's where the money is going to go. The company contributions or the company match dollars that you would get is always going to go into a pre-tax bucket because this company's not going to pay the government taxes on your behalf for those contributions. So if you're trying to hedge your bets of saying, okay, I want to kind of do half and half, just know that 4% match, if you're saving at a higher rate, if you're getting that 4% match, that 4% is always going to go into a pre-tax bucket. So kind of figure the math out. If you want to save 10%, and you want to kind of split the difference, maybe add 1% to pre-tax, so it's 5 and 5 or something like that to get to that number. So just do the math around it. Hopefully that's not too confusing, but I wanted to provide that detail as well. So, are there any questions on the pre-tax Roth, how much, company match at all?
Well, now the way you just said that, is there a company match on both pre-tax and post-tax?
So it tabulates to be the exact same benefit. So if you do 4%, or so if you save 5% Roth, you're going to get a 4%, pre-tax contribution going into your amount. It's all based off of your income, not necessarily what you contribute. So it works out to be the same. So if you're going to get, let's just say you're saving 5% Roth or saving 5% pre-tax, one works out to be $500 and the other one works out to be $480, you're still going to receive that 4% pre-tax contribution, and it's literally the exact same amount.
Okay. Is there a cap on 401k annual contributions?
So the annual contributions for the employee, and only the employee's dollars, is $19,000 a year, and that's for both the pre-tax or Roth. So you could technically do, 9 and 9. You could do 8 and 10. You could do 19 in Roth, 19 or 19 in pre-tax, but the combined total has to be $19,000 or lower. If you're over, if you're over age 50, there's what's called a catch-up contribution, which is an additional $6,000. So if you have anybody over age 50, they can put in a maximum of $26,000 per year in the 401k plan. Now, the company match does not, or is not, part of that calculation or a part of that total. That's sold separate.
Okay.
And then in addition, just kind of food for thought, you can always do an IRA contribution in addition to a 401k contribution. So those limits are separate. So if you've got an IRA out there at another company or custodian, you can save, the IRA limits as well, in addition to the 401k limits. And I believe the IRA limits right now this year are $6,000 for anybody under age 50. Over age 50, it's an additional $1,000 for catch up. So like $7,000 is a maximum total for somebody over age 50 in an IRA. So you could do $6,000 in an IRA, $19,000 in a 401k, and have a combined total of roughly $25,000 of total savings in a qualified account.
Okay.
And all of those stuff, things do change from year to year with the limits. They get increased slightly, every year, every couple of years, they get moved around. If you just Google, 401k contribution limits or IRA contribution limits, that's the easiest thing to do. The IRS website, tax advisors and things like that is recommended as well, just, for your individual financial circumstances.
Okay.
Awesome. So we're going to hop down to kind of the fourth decision, or what I call is the brick wall effect, is most people can get around pre-tax or Roth, the how much piece, understanding the company match, if they're going to save or not. And the investments often are the hardest. And we've got a lot of choices to pick from. All of these are all institutional grade mutual funds. And what that mean by that is they're all low cost options. Each of these two are top in their respective categories. So Mark and I's primary role is to make sure this menu is the best that it possibly can be, and then we review it every quarter. And if there's a fund that hasn't done well for consecutive quarters, we'll pull that fund out and replace it with a like kind fund. So we're always constantly making improvements to the lineup so it's the best available for you to pick from. You've got a lot of options and a lot of diverse choices to pick from. But telling you've got great funds and great choices to pick from doesn't help with that selection. So part of Mark and I's kind of final advice and tips for you, I'm actually going to scroll in so you can see this. We put together what's called a model asset allocation guide every quarter. And this is a breakdown for those who want to be hands-on with their investments or hands-off. And there's two kind of scenarios. We'll talk about both. This larger rectangle is going to be the hands-on, which is that top one. And then the bottom left is going to be the target date funds, which are more hands-off. So the top column here is going to be for those individuals who want to be a little bit more hands-on with the investments, but follow investment advice from Mark and I and from our team here. We've got all of the investment options listed on that left-hand column. There's 5 different risk tolerances that we've put together, from conservative all the way to aggressive. And we've put together a diversified lineup of what we feel would be the best choices given those available funds. So if we were you in your plan, how would we invest our money given these 5 risk tolerances? And that's how it's made up. From an education standpoint, folks in their 20s and 30s tend to be in that aggressive column, 40s and 50s in that moderate aggressive column. Folks in their 60s or at retirement would be in that moderate 50-50 blend in the middle. And then in retirement, you can, argue for the conservative or moderate conservative columns just for more preservation. So the ask is, if you're going to follow this column, we do tend to update these numbers about twice a year. So those numbers, that 4%, 6%, whatever you see there, we make slight adjustments to that. It might go up, might go down. One fund, maybe completely be swapped out as well, and that whole line item may go to a different number as well. So I want to ask if there's any questions on that. Does that make sense on the top rectangular?
Yes.
Okay, awesome. So the next piece is going to be more of the hands-off options. And the way these target date funds work is you would find out what year it will be when you reach age 65. So do the math around what year it will be. That's going to plop you into one of these target date ranges or in that middle column. And then that would be your most appropriate target date fund. So you would go 100% into that one choice, and that would be your sole selection. The blue ones that I've highlighted are going to be very similar to those aggressive columns. And the reason being is the bigger the year, it just means you're going to retire later. So you're younger. So it's going to start out aggressive for those who are younger. And then individuals as they're in their middle working years, like the 2025 fund or the 40 fund, those people are going to be in their 40s and 50s. And then folks that are nearing retirement are going to be closer to that present year because they're going to be retiring soon. The way these work is they're going to start out aggressive in roughly 90% in equities or stocks, and then every 5 years they de-risk automatically. So it's really a set it and forget it type mentality. It's good for somebody in their 20s. It adjusts over time as they get older and older. And then right when it reaches, the retirement year or that present year, it's roughly a 50-50 portfolio. So it starts out aggressive, over that, call it 50 year or that 40 year kind of down cycle of working. It then reaches a 50-50 moderate portfolio at retirement date. So we've got a hands-on option, hands-off option. The third is you're free to do whatever else you would like. We're just wanting to provide a little bit of a guidance roadmap of what we feel would be appropriate for those two scenarios. There are no cost of trading. There's no penalties of changing funds. You can do it every single day if you wished. We don't recommend that, but you could. And you'll have 24/7 access to the website through Retirement Plan Consultants, and I can access your account statements, look at performance, make any adjustments, change your contribution type, change your investments, all that stuff. Nothing that we talked about today is set in stone. You can change your pre-tax and Roth contribution. You can change your how much contribution, and you can also change your investments. So, our contact information is always on this sheet as well, and it'll also be in the body of the email if you would like to reach out to Mark or I. So, quick signature on the bottom of this form if you're filling it out as a waiver or an enrollment form. Everything that we've talked about today can be done on the website as well through the enrollment, kind of login as well. So, wanted to leave it here for just open for a couple questions. We've got two quick things just to cover as a housekeeping thing, but other than that, are there any questions about enrolling, investments, or anything we've covered so far?
Let's see. Start date is when?
Totally up to you guys. I would say target next payroll. If the next payroll is too soon, I would say the following one. But it's literally 100% on you guys from a coordination of, getting the employees logged in. Like I said before, if they wait a month, it's not the end of the world. They'll just pick it up the following month if they're dragging their feet.
Okay.
So hopping to the last two things is a beneficiary. Online, as you're doing the enrollment, you can put in your beneficiary information. In the event that you pass away, the monies that you've accumulated go to whom you wish. So make sure you're got that information online. It's best that it is online rather than paper form. If you're filling out the document as a waiver and you're not going to participate, you don't need to complete the beneficiary. The beneficiary is for those who have money going into the account or have money in the account. There's a quick IRS rule that I like to remind people of. This really almost applies on all financial accounts, not just 401k plan. But a spousal consent is required if you are not naming your spouse as primary beneficiary. So if your spouse, you're legally married, is not first in line or primary beneficiary at 100%, they have to acknowledge that they're being skipped, and a witness notary also has to sign and be presented with that form too. So not sure if that is any of your circumstances or not, but don't want to create any arguments at the dinner table tonight or this week. It's just an IRS rule, so be mindful of that. And then the last and final thing is just an account rollover. In the event that you've got an old 401k IRA out there, 457 plan, 403b plan that you want to consolidate or roll into this plan, you can. There's a team at Retirement Plan Consultants. There's actually a gal by the name of Stephanie Wolf. Wonderful lady. She's super smart, really nice to work with. And she can help do all the heavy lifting for you and coordinate, with the other company and getting that money from them over to Retirement Plan Consultants. So if that's of need, you reach out to us, let us know. We'll get you hooked up with Stephanie and she can take it from there. It also works on the outbound. So if you're no longer working for the company and a year from now, 6 months, 10 years, 20 years, you can roll those monies out of the plan if you're a terminated employee or, have a termination date, essentially, no longer working. So that was all that we wanted to cover. Any final comments, questions that we can help at this time or answer at this time?
I don't think so. Very helpful, though. Thank you.